In this video, you'll learn about sales returns and allowances and how accountants record them. In a prior video, we looked at this listing of 5 accounts that are used to record merchandising sales transactions. One of these new accounts is for sales returns and allowances, a contra revenue account with a normal debit balance. Merchandise companies want to track how much merchandise is being returned by customers in a separate account. It is a problem area that companies need to address quickly if it is a material amount. Companies don't earn money by buying a product, shipping it to a customer, only to have to take the product back and return it to the supplier. Accountants closely monitor this account because a high amount in this account is a sign of ineffectiveness and inefficiency. The accountant would likely analyze the account and prepare a report that displays what products have the highest returns or what customer returns most of the products. Another possibility is that the sales team is sending too much product to customers, perhaps for purposes of increasing their commission, which is more of an internal problem that should be addressed very quickly. Another possibility is that the company has just too generous of a return policy and needs to understand the cost of that policy. Let's look at how we distinguish sales returns from sales allowances and how they are recorded. The sales return occurs when a customer sends a product back and requests a refund of the amount paid. Like many people, I order things online, and sometimes what arrives looks different than I expected, or is either too big or too small, it arrived too late, or just doesn't work. There are lots of reasons why a customer returns a product, and most retailers track the return reasons because those reasons are valuable information. When you want to return a product on the Amazon app or website, it asks you for the reason you're returning it. And once you return the product, you get your money back. The supplier may restock the item if there's nothing wrong with it, or repair it and sell it as refurbished, or dispose of it. Sometimes it is impractical or impossible to return the item. For instance, when it has already been consumed or it is broken, and the seller still issues a full refund. Other times, the supplier issues a partial reduction in the price, a sales allowance, because there is some kind of problem with the product, but the buyer is still willing to keep it. Like when I bought a dress at Macy's, I later noticed an issue with it. The store did not have the same dress in the store, and I did not want to wait to have it shipped to my house. It wasn't a big issue to keep it, and the store gave me a discount, an allowance on the dress. So that's different, right? You want to keep the product or are willing to keep it, but think that the price should be lower because there's some kind of problem. Sometimes overseas companies also use allowances because the cost to ship the product back, especially if it is damaged and would just be thrown away anyway, is more than the product is worth. And the company doesn't want to waste that money. Let's now look at a few examples to practice sales returns and allowances. Here's an example of a cash refund for a sales return. The company accepted a return and issues a cash refund for a return of $100 in merchandise sold for cash plus sales tax of $8. Let's analyze this transaction by determining what accounts increased or decreased. In this transaction, cash decreased because the company gave money to the customer. Cash is an asset and assets decrease with credits. Sales returns and allowances increased. Sales returns and allowances are a contra revenue account with a normal debit balance. Contra revenue accounts increase with debits. Sales tax decreased because the company refunded the sales tax previously paid by the customer. Sales tax is a liability, and liabilities decrease with debits. And we're now able to record this cash refund by writing the date into the date column, sales returns and allowances into the description column, and $100 into the debit column. We record the reduction in sales tax payable by writing the sales tax payable in the description column and $8 into the debit column. On the next line, we slightly indent and write cash into the description column and $108 into the credit column. Let's look at how this transaction changes when the customer is a credit customer and hasn't yet paid for the original purchase. On January 20th, Ann On returned a weight set that she previously purchased on credit. Max Out Sporting Goods issues a credit memo 101 for $216. Let's analyze this transaction by determining what accounts increased or decreased, the account type of these accounts, and then the debit and credit. In this transaction, accounts receivable decreased because the company issued a credit memo but did not give money back to the customer, but instead reduced the amount Ann On owes Max Out. Accounts receivable are assets, and assets decrease with credits. Sales returns and allowances increased. Sales returns and allowances are a contra revenue account with a normal debit balance. Contra revenue accounts increase with debits. Sales tax decreased because the company refunded the sales tax previously paid by the customer. Sales tax is a liability, and liabilities decrease with debits. We can now record the transaction in the general journal by writing the date into the date column, sales returns and allowances into the description column, and $200 into the debit column. The sale also included sales tax, and we need to debit sales tax payable because Max Out now owes less sales tax. We record the reduction in sales tax payable by writing sales tax payable in the description column and $16 into the debit column. On the next line, we slightly indent and write cash into the description column and $216 into the credit column. I hope this video about sales returns and sales allowances was helpful, and you now feel comfortable recording these type of accounting transactions in a journal entry.